The difference in 2-year and 10-year Treasury yields is at the widest ever, 285 basis points. And that is as investors bet an accelerating recovery will fuel inflation and dampen demand for government debt. So joining us now with his thoughts on the significance of this steepening yield curve is Dan Greenhaus. He's chief economic strategist at Miller Tabak. Thank you for joining us. Dan, we talk about how the steepening yield curve reflects economic optimism, but is it really as simple as that?
Well, there's a couple of things that go into the steepening of the curve in general, and especially right now. The unique circumstances surrounding the steepening this time around is, of course, the Fed, which is holding short-term rates at zero. And as confidence in the economic rebound grows and concerns about inflation seep back into the economy, you see upward pressure on yields at the longer end, but there's an anchor holding down the shorter end, the result of which, of course, is the steepening that we're seeing now.
That artificial pressure.
The artificial pressure.
Okay, now we know the winners are generally banks because they borrow short and lend long. That's good for them. Who are the potential losers?
Well, there's no real direct potential losers that come to mind. I can say, though, that, of course, as yields on the 10-year move higher, this, of course, is the basis for just about everything in the universe right now. And with respect to consumers and borrowing costs throughout the economy, things get a little bit more difficult as interest rates start moving higher. The 10-year yield to the average person throughout the economy is much more important than the 2-year yield.
Sure.
Specifically, mortgage rates are among the things that are priced off, 10-year, 30-year, whatever, whichever way you look. How much of a risk is that, though, to the housing recovery as we look out into 2010? We've already seen mortgage rates rise over the past couple of weeks.
Ultimately, this is probably the biggest concern that we should be having with respect to the economic rebound. When Miller Tabak put out our 2010 outlook, we had a section on housing where we disagreed pretty strongly with the consensus view that the housing market is off to the races, so to speak. I think higher interest rates present a real problem for the ongoing recovery in the housing market, and the idea that this has become a self-sustaining continuous recovery in the housing market, I think it's something that I disagree with. Now, it's hard to quantify exactly what difficulties are going to occur as a result of higher mortgage rates, but certainly lower mortgage refinancings and a lesser ability to purchase a home, those are going to be realized pretty soon.
Dan, I'm just looking at a chart here of the difference between the 2s and the 10s over the past year, and it shows that obviously between June and November of last year, we saw a big run-up in the yield curve, or at least a big steepening of the yield curve, and that dropped off dramatically after the nightmare in November of last year. Is that what it would take to flatten the curve again, a double-dip recession effectively?
Well, not solely, but certainly the prospect of a double-dip recovery would do it. I think what you're seeing at the outset here is a steepening of the curve, which probably should continue through the first quarter or so. I don't know exactly where we're going to end up, and we're not getting there in a direct line, but we could end up somewhere between 300 and 325 basis points. But towards the back half of the year, as the Fed begins to remove some of this liquidity and perhaps some of the concerns about inflation come out of the market, you're going to see this flatten out somewhat. Okay,
with the yield curve at 285 basis points right now, the 2s, 10s at least, to what extent are slow trading conditions contributing to this steepening?
Well, certainly when you get towards the end of the year, slow trading conditions play a part. Volume in the Treasury market right now is like the equity market, quite low in comparison to where you would see in the middle of the year or in the fall. The bigger question, of course, is year-end flows. What are people doing with respect to portfolio allocation, large traders in terms of getting into or, in this case, getting out of the Treasury market in order to show that you're not hiding in what is relatively viewed as a safe market while the equity market continues to power higher.
Now, who, in addition to banks, benefits from this? I was actually reading a story in the FT today about some hedge fund managers, including John Paulson, who've made a bet, and Julian Robertson, who made a bet on a steepening yield curve. Are there any other sort of investor types who might prey on a steepening curve?
Well, I think the idea that you would be investing or looking for a steepening yield curve is certainly something that you would leave to professional investors, so to speak. Retail investors have really no business trying to time the steepening of the curve. I think from a general perspective, if you find yields attractive from a safety standpoint or from a return standpoint, then that, from a retail standpoint, is what you're interested in. Betting on movements or correlations is certainly something that retail investors should not be doing.
Too hard to time. All right, thank you so much. We've been speaking with Dan Greenhaus of Miller Tabak.